This is Matt Godleski with Stewardship Financial Advisors Investment Committee, bringing you this week's snapshot edition of The Pulse. Here's what we're watching this week. Stocks move higher from the September doldrums, while COVID in Washington and elsewhere is raising alarm bells, and fiscal stimulus pressure leaves investors hopeful. Equity markets charged onward and upward this week, shrugging off COVID hitting the White House and a lack of progress in passing a financial aid package for the U.S. economy. Despite an uptick in cases in certain hotspots and the election thrown into further disarray with infections in Washington, markets were hopeful that a deal can be reached soon to help bridge the hole created from the virus this year. On the economic front, data showed a mixed picture, with jobless claims edging lower, but remaining extremely elevated and continuing claims falling more than expected. U.S. railroads are reporting one of the strongest activity readings in history as retailers restock inventories for the upcoming holiday season, but many question the sustainability of the reports. Meanwhile, in markets, the ongoing theme of a rotation into stocks that benefit from a faster reopening and stronger rebound have continued to outperform, while the winners of the stay-at-home trade lag. This theme hinges largely on another round of stimulus and could unwind rapidly if no deal can be had. The upcoming election and bargaining in Washington will be closely watched to determine the sustainability of the rally in cyclicals. Revisions to the size of the contraction and subsequent rebound continue to be made by economists, believing the COVID crisis had a smaller effect overall and the recovery is on pace to be quicker than anticipated. Regardless of the outcome of the election in the coming weeks and months ahead, the economy appears to be progressing despite the deep scars left from COVID. While the economy will take time to heal and the jumpstart in activity is slowing, the trajectory remains positive for now. We continue to maintain our neutral positioning in risk markets at this time. Continued positive surprises in manufacturing, factory orders, and durable goods, coupled with an improving labor market and strong consumer sentiment, belie our constructive outlook on equities. We have been selectively rebalancing portfolios to take advantage of the cyclical upturn that we believe will be sustained, particularly if and when a stimulus package is unveiled in the coming months. Meanwhile, bonds are in a precarious situation, priced very expensively, with U.S. government bonds yielding less than 2%. We are exploring more non-traditional sources of diversification and downside hedging, as we have concerns that bonds with rates as low as they are provide little protection from a major risk-off event in the future. Therefore, cash plays an ever more important role in portfolio construction, as liquidity needs remain high with the amount of volatility surrounding the election and the path of the virus. Downside risks remain elevated, with upside limited unless earnings can rapidly increase or additional policy support can be deployed above expectations. Thanks for watching, and check out our website to read the full version of The Pulse for more details.